bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the August 19th, 2025 episode. My guest this week is Nicolo Pinoli. He's a partner in Novogradac's Portland, Oregon office. Nicolo is one of Novogradac's leading experts in several of the tax incentives we cover on this podcast, including, of course, today's topic, which is the low-income housing tax credit. Those of you that listen to a recent podcast know that Nicolo is back on Tax Credit Tuesday for the second time in just over a month. This is the second and final installment of a two-part discussion to help developers and many others who work with low-income housing tax credits better understand some of the nuances of partnership agreements when it comes to raising equity for affordable rental housing through low-income housing tax credits. This is the latest episode in our ongoing So You Want to Be a LIHTC Developer series. This is a series that we designed to help developers, investors, syndicators, and others learn more about financing affordable rental housing with low-income housing tax credits. Now, you don't need to have watched or listened to part one in order to watch or listen to this episode, but it's certainly not discouraged. I'll post a link to that earlier episode in today's show notes. In these two episodes, we're talking about partnerships, which includes limited liability companies, commonly called LLCs, that are taxed as partnerships. Now, in today's part two episode, Nicolo and I will discuss first the importance of having partnership allocations of tax attributes be respected. And then we'll discuss the requirements to have allocations of tax attributes be respected. And when we say that, there is a safe harbor. There are a set of regulations that create a safe harbor. And if you don't qualify for the safe harbor, then you fall under a partnership interest in profits, a PIP approach. And a PIP approach, you never really know what the allocations are. But we'll talk about that in more detail in a moment. We're also going to talk about exit taxes and talk about the fact that many affordable housing developments end up having notable residual value at the end of year 15 and how that influences developers' choices in negotiating a partnership agreement. So now, as you can see on the screen, Nicolo is here ready to go, and I'm ready to go. We have a lot to discuss. So if you're ready, let's get started. Nicolo, welcome back to Tax Credit Tuesday.
Thanks, Mike. It's great to be with you once more.
Yes, this is your ninth appearance on Tax Credit Tuesday. And before we go into the second part, even though you did discuss this in the first part, please briefly describe the services you provide to Novogradac clients.
Well, I guess I've got to come back again so I can get into double digits, but
Yes, you do.
For those not familiar with our organization, we are a full service CPA firm, and we do all of the traditional services that you're used to CPAs doing, things like audits and tax returns. As well, I do a lot of work with clients in closing deals and structuring deals, as well as a lot of forecasting work. And when it comes time to navigate the exit, I work a lot with clients on working through that process. And so soup to nuts, cradle to grave, I'm with you to help you get through all of the fun that comes with the affordable housing development process.
Great. Thank you for that. And I will include Nicolo's contact information in the show notes. So Nicolo, before we go into the, deeper dive of the tax and partnership issues we're going to talk about in this podcast, for those listeners and viewers that didn't watch the prior episode, as well as a reminder for those that did listen to or watch it, please share a very brief summary of the critical points we discussed in the last podcast.
Sure. And I do encourage everyone to go back and re-listen to it because it's a delightful romp through a lot of the theory and details around partnerships and using partnerships to develop affordable housing. But certainly they're a crucial structural element for raising equity to finance affordable housing, largely because they provide tremendous flexibility in achieving both business and tax objectives. We talked a lot about a limited partner and their requirements to be respected as a partner, and how they really need to have upside and downside potential rather than merely receiving the tax benefits that come from being a partner. Certainly, we talked a lot about the importance of making sure those tax benefits actually get delivered to the limited partner as expected. Otherwise, there will be some challenges with that limited partner and their ownership interest and making sure that we make them whole. And lastly, we talked quite a bit about public policy benefits and leaning into these partnerships because they're really powerful tools for delivering affordable housing and making it all happen in ways that really maybe couldn't happen quite as well without these partnerships. And we also talked a little bit about some traps for the unwary, just because there's always things that can go wrong if you don't know what you're doing.
Thank you for that overview. Now I want to jump right in to the meat of this podcast. And virtually all loan against tax credit transactions raise equity through partnerships. It's not absolute, but it's almost absolute. And if capital is being raised through a partnership, then the partnership has to allocate the various attributes of the partnership interest among the various partners. They have to obviously allocate and distribute cash, and then they also receive capital contributions. They also obviously have tax attributes, tax credits and tax losses that need to be allocated among the partners. And as I said in the introduction, it is no news to those in the loan against tax credit community. It's very important for the allocation of those tax attributes, the credits and losses, to be respected. Please kind of explain, why that is so important, and maybe explain a little bit more about how we end up wanting to try to qualify or go in believing at a high level of confidence that the allocations will qualify under the safe harbor.
Sure. And I think for a lot of you who maybe aren't used to developing affordable housing, if you've been in the market rate space before, this may seem a little foreign to you, simply because it's not something you have to grapple with or certainly don't care about in the same fashion that we do over in the affordable housing space. And as you mentioned at the outset, Mike, the Internal Revenue Code gives us one set of guidelines. It says that partnerships allocate tax attributes to their partners based on the partner's interest in the partnership, which is not real well defined and which is scary for those of us who care about how the tax attributes, including tax credits, get allocated. And certainly outside of affordable housing, with more market rate housing, many real estate deals are actually done with PIP being the approach they take. And often they even use what we call targeted capital accounts, where they know where they're going to end up, or they hope to end up in the end. And sort of over the years of ownership of the asset, they make their way in that direction until they can get to those targeted final ending capital accounts. But unlike market rate housing in the LIHTC world, we definitely care about allocations of tax attributes because they're a critical aspect of the economic bargain between the parties.
Let me just interject there a second, just to emphasize your point about target cap accounts or target allocations. Is in most real estate deals, cash flow is what it's all about. And the parties are basically looking at the agreement and saying, we want to make sure we know where the cash is going. And we have our cash waterfalls and all the rest, and cash is king. And so that's going to be paramount. And then we're going to then allocate income and loss and the rest in a manner that we think most approximates getting the capital accounts in the right place based upon how the cash is going to go. And they end up running a risk that at any given year, the IRS would reinterpret how those allocations go. But the partners themselves, cash flow is so important that running a risk that those allocations wouldn't be respected isn't considered a significant issue relative to the cash being first. And as you're transitioning to LIHTC transactions and just tax credit partnerships in general are the flip of it.
That's right. Maybe to use a slightly different analogy, when it comes to market rate investors, the tax benefits are really the icing on the cake. The actual
Yes.
economic benefits, that cash flow and
Like it.
residual value,
Like
that's
it.
the cake. And on the flip side, when it comes to the tax credit world, the
Yes.
tax benefits, they are the cake. And to the extent that you have any cash flow, that might be icing on top of the cake,
Yep.
but certainly the main cake itself is those tax benefits. So that's why it's so critical that those allocations be respected. So as a result, in LIHTC land, we really want to avoid this whole PIP thing. And because in a lot of ways it ends up being kind of a murky maw, and you don't want to end up caught in PIP. But instead of going the PIP route, you can meet a safe harbor. You can qualify for the safe harbor. And the Internal Revenue Code gives us certain criteria and tells us that if you meet these various criteria, then we'll respect your allocations of income and loss. And so as a result, in the LIHTC space, we're very, very focused on meeting this safe harbor. So there are a handful of key elements. And if you're ever reading your LIHTC partnership agreements, you'll find there's a section, usually around the middle of that partnership agreement, where they have a lot of what looks like very boilerplate language. And I said boilerplate language to talk through all the requirements here in order to meet the safe harbor. And some of the key elements associated with this safe harbor are that the partnership must maintain capital accounts for the partners. That is one of the fundamental aspects. The partnership agreement itself must outline the allocation of partnership tax items. So in a LIHTC context, usually you end up identifying, say, 99.99% of credits and losses get allocated to the limited partner and 0.01% come over to the general partner, give or take. Sometimes some variations on a theme there. Those allocations that are outlined in the partnership agreement, when the partnership actually makes those allocations, they have to have substantial economic effect. And that's a fancy term, but it basically means that when a partnership makes those tax allocations to the partners, it actually has to impact the economics, actually has to impact the cash that a partner ends up receiving from the partnership. And the last major condition, indicia, criteria is that the partnership must liquidate based on those capital accounts that you've been keeping while the partnership has been in operations. And I don't know, Mike, if you wanted to poke at any of those or talk a little bit deeper about some of those safe harbor requirements.
That's thank you for giving me the opportunity. I would have taken it anyways. I do think it's sort of like bookkeeping. I look at this and just say it's bookkeeping, saying if you put capital in, and you have to maintain these accounts, if you will, among the partners. And then as you make distributions, allocate items and all the rest, you're keeping track of these capital accounts. There's who has what. And then at the end of every year, the partnership agreement needs to sort of provide that if you were to end partnership at the end of a given year, you would liquidate in accordance with those capital accounts. And so it's just a way of saying that by virtue of these allocations, your capital account is changing. And as long as you liquidate in accordance with capital accounts, then that would affect the cash you receive, as you mentioned. So it's at some levels, it's sort of simple, but obviously anyone who's dealt with these issues before knows it's not simple, because embedded in all that we've discussed and we're going to discuss, there are a lot of rules within these capital account maintenance regulations that govern how you maintain your capital accounts in order to ensure this is the case. And then you also deal with situations where it's not as obvious how you can affect someone's capital account and allocation of a given tax attribute.
And maybe just talking about tax attributes, let's talk about the two most important ones, and they move together. And why we care that these attributes are respected, because in LIHTC land, tax credits follow depreciation. And so therefore, we want to make sure that the depreciation is allocated in a fashion that those allocations are respected. such that the tax credits follow that depreciation and go right where we want it to go, which is 99.99%, give or take, coming to or going to our LIHTC investor. All of which is a long way of saying it's absolutely critical to make the safe harbor so that the allocations of depreciation and therefore credits over to our tax credit investor are respected.
And that is the central point. So that was a great time to interject because that's what this is all about. It's all about the depreciation allocation being respected. I will note that, we believe that's the same for new markets. We think with new markets, how you allocate the basis adjustment, even though we've never gotten guidance from Treasury to that effect. What's interesting is with respect to ITC, historics and renewables, it actually follows profits. And those are just the ITC is a separate carve out through Treasury prior guidance where those tax credits follow profits, but virtually every other credit will follow the allocation of the depreciation or expensing or basis reduction associated with the cost that generated the credit. Probably more than our listeners wanted to know, but for those that are doing combined historic deals with LIHTC and the rest, that becomes a more meaningful matter. So go ahead.
Maybe just to make one more point, part of the fun is that credits themselves don't affect your capital account. And so that's why we end up having to look to these other things.
That's right.
In terms of how we determine how credits are allocated.
And that's how they're in essence deemed to have economic effect if you allocate them in accordance with, for historics and ITC profits, but for all the other credits, underlying cost. And it sort of makes sense that if you can't allocate the credit because it's not affecting your capital accounts at all, you should tie it to something, and it makes sense to tie it to what the cost that generated the credit. So I mentioned briefly about capital accounts, but please give a little bit of a deeper walkthrough what it means to maintain capital accounts properly. And this is important, obviously, for developers, not just in negotiating the agreements, but also when they're doing the actual tax returns every year and they're doing their bookkeeping and the rest. They should be following these capital account maintenance rules for the most part, depending on how their books and records are kept, which I won't go into detail on that front.
Yeah, so I remember vividly as a brand new staff at Novogradac and working on one of my first tax returns, and I was rolling forward capital accounts from the beginning balance, adjusting for current year loss and ending up with an ending balance. And then when I got done with that, I looked at it and I thought, what did I just do? Does this mean anything? There's numbers on a page, and yet I wasn't fully understanding just how important those numbers were and what it all meant. And I think for our audience, sometimes they may not understand that capital accounts represent each partner's claims to the net assets of the partnership. If you think about outside of a partnership context in a corporation, corporations have shares. And each share represents a fractional claim to the ownership of the corporation, depending on how many shares are outstanding. Partnerships obviously don't have shares, at least not in the same way that corporations do. And since partnerships do allow for special allocations, that means we need capital accounts to help us calculate each partner's claims to the net assets of the partnership. So how are those capital accounts calculated? And I find that's a common question I get from clients, because as soon as we start talking about them, where's the math that goes into how we maintain capital accounts? And it's actually fairly simple. Capital accounts are increased for capital contributions. Obviously in LIHTC land, that usually means cash contributions, but in theory, it could include non-cash contributions as well. Capital accounts are decreased for any distributions, usually also cash distributions in LIHTC land. And then they're increased for allocations of taxable income that also happens to include tax-exempt income. And finally, they're decreased for allocations of taxable loss, including non-deductible expenses. So for your average LIHTC partnership, who probably doesn't have much in the way of taxable income most of the time, and usually might not have a whole lot of distributions, about the primary movers of your capital accounts are when capital comes in the form of capital contributions, your capital account goes up. And then each year as you allocate losses to the partners, which is typical in a LIHTC situation, you end up with those losses reducing the capital accounts. And so, as you mentioned, Mike, it's really just a math exercise, a little addition, a little subtraction, but it's obviously critically important as a math exercise to make sure that we're following the rules. And certainly, as those capital accounts, they get big when we make capital contributions up front. Over time, they erode and they can potentially go negative. And when they do end up in a spot where they end up going negative, then we get into a situation where we have to think long and hard about what that means, because there are potential consequences to especially a limited partners capital account going negative.
So let's talk about that. But before, I just wanted to note to our listeners that when we're talking about maintaining capital accounts and all the rest, under the regulations, technically, it's your Section 704B capital accounts, your capital account for purposes of these rules, and why they generally approximate your tax capital account. There are a number of ways in which they can be different. And theoretically, you need to be focused on the 704B capital accounts as opposed to the tax basis capital accounts. And I mean, one example would be Nicolo mentioned a contribution of property. Contribution of property will carry over for tax purposes at the basis of the partner, unless it's a disguised sale, and I won't even get into that. But on the flip side, for several capital account purposes, they want to ensure the economics are respected. So they want to know what the fair market value is of that interest and see that the fair market value is getting reflected in the capital account. And there's a number of other examples. So Nicolo, you talked about, capital accounts, quote, going negative. And what that really means is that for a limited partner, capital account to go negative, there have to be losses in excess of the amount of capital that partner put in. If the capital account goes negative, then that means the partnership has generated losses, obviously beyond what that limited partner contributed in cash. So generally that means that it has to be paid somehow. And so if I think of my double entry bookkeeping, if a partner's capital account, if there are losses in excess of the capital they contributed, this is cumulative losses in excess of the cumulative capital the limited partners contributed, then what's funding that loss? And I think what could be funding that loss? The general partner could have put capital in, and that could be funding the loss. The general partner could have guaranteed a loan, or there could be loans within the partnership that the general partner is liable for. And then thirdly, there could be non-recourse debt on the property in which neither the limited partner nor the general partner is liable. So if you could first talk about the losses when they're attributable to the capital put in by the general partner or it's debt that the general partner guaranteed. So the general partner at risk of loss with respect to those losses, how those have to get allocated. And then we can talk about this concept of losses attributable to debt that neither partner is personally liable for. So I tried to explain that in a way that hopefully set it up in a logical pattern. That being said, please build out what I just discussed there.
Yeah, when it comes to limited partners, there's an important word in there. That's the whole limited word. And the limited part of being a limited partner means that, at least from an economic perspective, your losses and your liability for the losses of the partnership are limited, which is part of the reason why it's so attractive to potential investors. And what that does is it creates an exciting dynamic under tax law. Once a limited partner has been allocated losses in excess of the capital they've contributed, you're right, you end up in a situation where you have a potential negative capital account, in which case you have to look around and say, well, what's financing further losses? And Mike, you mentioned the possibility of other sources like general partner equity, or you could have debt, including recourse debt or non-recourse debt. And depending on what it is that's financing those additional losses will really determine how those losses get allocated. And I think as a practical matter, That's sort of the whole notion behind substantial economic effect is whoever bears the risk of loss, that partner really should be the one who is allocated that next layer of loss. And when you think about general partner capital accounts, those generally are going to attract losses up to the amount of the general partner capital contributions. And for that matter, when it comes to recourse debt, either debt that's been loaned into the partnership by the general partner or that has a guarantee from the general partner, that will similarly attract losses that get allocated over to the general partner. But setting aside those for the moment, because those might be a source of allocation over to the general partner, to the extent that you have truly non-recourse deductions where the losses are not attributable to general partner capital accounts or to debt that is recourse to the general partner, then you end up in this nice spot where those deductions are non-recourse. They really relate to non-recourse debt, in which case really the lender then is the party that bears the economic risk of loss. Luckily, we don't have to give a K1 to the lender, allocate them a bunch of losses. I'm sure they'd be excited to get that K1. But instead of doing that, the Internal Revenue Code gives us an alternate rule in which we can continue to allocate losses to our partners, even though there's no risk of loss tied directly to those partners, under the alternate rule, which we often refer to as minimum gain. And when I think about minimum gain, it's as you mentioned, Mike, you start thinking about your balance sheet, you start thinking about debits and credits. And it's certainly a rule that exists in a real estate context to make sure that once partners' capital accounts have been fully exhausted, the partnership can continue to allocate those non-recourse deductions to the partners. And within a partnership context, it's a great tool for continuing to allocate depreciation deductions. And in LIHTC land, that means we continue to allocate our LIHTCs onto the limited partner, which is, I think, one of the primary tools we use when we're faced with a situation where our limited partner is going negative. Some other options, though, do exist if you're in a situation where maybe we don't have minimum gain yet, maybe because we have some of these other situations where losses are being attracted to being allocated to the general partner. And some things we could do include things like deficit restoration obligation agreements, often limited in duration and limited in amount, where the limited partner agrees to contribute a certain dollar amount to the partnership if the partnership were to liquidate or go out of business within that window. You could theoretically add guarantees from the limited partner to sort of act as one of those forces to help attract losses to being allocated to the limited partner. You could also have some partner non-recourse debt that comes from the limited partner. And sometimes that's also an important factor. And I think anytime you end up in a situation where your limited partner either is negative or is heading in that direction, then you want to make sure that you are looking for and considering your alternatives for how we go about meeting these requirements so that we can continue to allocate losses to the limited partner.
Let me just sort of add to that, many partnership agreements now, if not most, if not virtually all, I'm not sure which of those categories it is, also provide that during the course of the lease up and early part of operations, if there are unexpected losses, that those unexpected losses will be allocated to the general partner. And I say that because, as Nicolo and many of our listeners know, when these deals are initially started, there's a 50-year projection showing that the allocations will be recognized for at least 11 years, go through year 10 of the credit period, plus the spillover credits in year 11. So you want to go even beyond that, 13, 14, you want to make sure that you have a little bit of cushion. And if you're finding that you have losses that you weren't expecting, either the income isn't high enough or the expenses are higher, a slower lease up, there are a number of things that could happen that could cause the losses in those early years to be higher. And oftentimes the agreement will mandate that those losses be allocated to the general partner so that you don't end up with this situation later. But that's maybe a 301 versus a 201. And let me also say, while I'm in the 301 stage, that everything that Nicolo and I are talking about, we also could be talking about various exceptions and even exceptions to the exceptions. And for the tax attorneys out there, we recognize that all these provisions are not from the Internal Revenue Code. They're from Treasury regulations based on the Internal Revenue Code, but colloquially, we use them sort of interchangeably. So don't call us out on that.
And maybe,
Back to you,
Mike,
Nicolo.
one thing we didn't cover, at least not directly, was the calculation of minimum gain. And so for those of you out there who are wondering, how is that calculated anyway? It's actually pretty easy. You start with your non-recourse debt, and then you compare that non-recourse debt balance to the assets that are secured by the debt. And the general concept is that if you were in a liquidation scenario and you were handing this property over to the lender, you would end up with a gain, a taxable gain, because the debt exceeds your tax basis in those assets. And so therefore, as a result, that under the alternative test allows you to continue allocating those losses to the partners.
Right. Thank you for that. Now let's go to fast forward to the end of the term. We're at in year 15, and there's a requirement to liquidate based on capital accounts. Please build out how that requirement affects the economic relationship between the partners, or more specifically, how any residual cash proceeds will be distributed between the general partner and the limited partner.
All right. Well, I do think this wrinkle, in my experience, it tends to be one of the most poorly understood aspects of our world. And I think for a lot of developers, you often look at your partnership agreement and it says something along the lines of how the back end gain will be shared, and maybe it's 80-20 or 90-10 or some other fraction. And you think that means that's how the residual dollars get shared between you and the limited partner. And I think the sad but true result is that often a limited partner share of residual cash flow could be larger than what you're thinking, larger than that percentage you're reading in your partnership agreement. And that's because of the capital account maintenance rules, and because of the way that those capital accounts are calculated, and then ultimately the way that partnerships must liquidate based on those capital accounts. And so, like I mentioned, just because there's a 90-10 split on the allocation of the gain on a potential sale does not mean that cash gets allocated 90-10. Instead, it means the general partner gets 90% of the gain on the sale, which is then added to each of the partner's capital accounts, 90% to the general partner, 10% to the limited partner. I'm assuming, of course, that your partnership agreement has 90-10. This is merely an illustrative example, of course. And then once you've added that gain to each of the partner's capital account, then the partnership would make liquidating distributions to the partners based on those capital accounts. And that's part of the fun of double entry accounting. Part of the fun of your balance sheet always balancing is when you get to the point where you've sold all your assets, the only thing you have left on your balance sheet is cash. You've paid all your debts. Cash and partners' capital will equal, and so that you will then liquidate and distribute that cash to the partners based on their capital accounts. What does that mean, though, in terms of that sharing ratio? If you have a limited partner who has a large capital account balance prior to the sale, the odds are good that that limited partner then will have a larger share of liquidating proceeds. They'll probably get more than that 10%. In some cases, it could be a lot more than 10%. I've seen situations where you could be looking at 50, 60, 70% going to the limited partner based on a sale and hypothetical liquidation of a partnership. And I think for everyone out there who's listening to this and thinking about their deals and where their capital accounts are at, you should know that there are planning and structuring opportunities that do exist to help manage those capital accounts, and therefore manage the potential liquidating proceeds that get distributed to each of the partners. My experience is that the sooner that you start the process of looking at those capital accounts and thinking about how you want to manage them, especially during the initial structuring and negotiation phase, then the greater the number of available options you have at your disposal, and I think the greater flexibility you have. But any way you go about it, certainly you need to be focused on it when you initially close, and then during the life cycle, carefully managing those capital accounts such that you know what your potential exposure is, and you're taking appropriate actions to manage those capital accounts as you go.
Thank you for that, Nicolo, and thank you for pointing out that there are structuring options that developers can include in a partnership agreement to help address that. I will also note that the large capital accounts generally you don't see in a 4% bond deal because the equity is a smaller portion of total project costs, so that appreciation generally will be enough to offset the capital contributed for the 4% credits. You generally see this in a 9% transaction, and 9%, particularly in the difficult develop area, without a lot of soft debt. So those are the type of situations that are more likely to run into this issue, but you definitely want to be addressing it up front at the beginning when you're running the numbers and thinking about how your partnership agreement should read to comply with the 704B safe harbor, but also give you some protections with respect to an immediate liquidation, immediate sale of the asset, and distributions in accordance with liquidation of capital accounts. So, Nicolo, there's also the opposite, where if the capital is not positive, then that means it's negative. I don't know if you've ever seen one that's exactly zero. And if you're negative, then there are exit taxes potentially that the developer agrees to pay. So please explain the concept of exit taxes.
Sure. And we do see zero capital accounts sometimes. Usually that's when we've gotten the limited partner all the losses they can take, and they can't take any more. And so that's when we get to zero and we don't get below that. But assuming we do end up going below zero into negative territory, then usually that does trigger an exit tax. And most partnership agreements require that the limited partner they receive a payment for any exit taxes associated with the sale of the property. And as I mentioned, typically that happens when limited partner's capital account is negative. Obviously, the capital account can only go negative if they meet one of the exceptions that we've been talking about that allows their capital account to go negative. My experience working with developers is that most developers are not big fans of exit taxes, simply because that means they get to allocate additional economic value over to the limited partner. The limited partner gets a slightly larger portion of the residual proceeds. And, and not only that, I think some of them look at it and say, gee, I've been doing such great work delivering all these losses to the limited partner. And now it turns out that all those great losses actually trigger this exit tax. And so it's almost a situation where you get penalized for doing great work in delivering lots of losses to the limited partner when those losses then unwind and end up triggering an exit tax. And certainly for my developer clients, as with capital account tracking for liquidation purposes, you should absolutely be looking at tracking capital accounts for exit tax liability so that you can stay on top of it and help manage that potential liability and take steps if needed so that you can mitigate the exit tax. This is also one that starts at the very beginning during underwriting. And in a perfect world, all my developer clients would say they really want to get to a spot where that limited partner gets exactly to zero on the day that the limited partner exits, so as to avoid a negative capital account that triggers exit taxes or a positive capital account that could trigger a disproportionately large liquidating distribution to the limited partner. And as with the structuring opportunities to manage a capital account with respect to having too large of a capital account, when it comes to having exit taxes and a negative capital account that triggers those taxes, there are lots of opportunities for planning, steps, and structuring alternatives that are available. Much, much easier to put them in place when you're originally structuring the project. But certainly opportunities do exist for mature properties, including things like restructuring your capital structure, even just things like capitalizing more repairs so that you're deducting less. reallocating operating expenses to the general partner such that that's fewer losses that are being allocated to the limited partner. Or in some cases, maybe buying the limited partner out early, such that if you buy them out in year 12 rather than year 15, maybe there's a small exit tax, maybe there's no exit tax. So those are just some of the big picture thoughts and ideas and strategies around how you go about managing the exit tax side of the coin.
So thank you, Nicolo. I appreciate you coming back for part 2 of this 2-part episode. I would encourage our audience to reach out to Nicolo about any questions, any of the many nuances to what we discussed today. If you're interested, if you're a developer interested in some of the approaches to addressing positive capital accounts in advance at the very beginning when you negotiate the partnership agreement or afterwards, please reach out to Nicolo as well. As I mentioned earlier, I'll include his contact information in today's show notes. Nicolo, what are some other resources you recommend our audience consider participating in to learn?
Well, I'd definitely say we've got the LIHTC working group, which is a really powerful working group of great participants within the LIHTC industry who come together to help influence regulatory language as well as future legislation and work through solutions as the group identifies opportunities and challenges they're all facing. In addition to that, we have a conference coming up just next month. I will be in Nashville along with Mike.
Yes, I will be there.
For the LIHTC conference, where we'll be discussing issues just like this both days during the LIHTC conference. So hopefully we'll see you there.
Thanks. And if you are interested in meeting Nicolo or me in person, come to Nashville. So I appreciate that, Nicolo, and I will include a link to those items in today's show notes. Please do stick around for our off mic section. But before we do that, I do encourage our audience to subscribe to Tax Credit Tuesday. If you're watching on YouTube, I also encourage you to like and comment on the video. I also encourage you to share the podcast with colleagues and other business acquaintances. It's a great way to learn more about the various incentives that we work in. And we do have a full archive of episodes available on our website at novoco.com. So now let's turn to our off mic section, where we use the space to give a shout out to others working in the tax credit community. It's an opportunity to highlight a professional worthy of recognition. So Nicolo, who would you like to shout out?
I'd like to give a shout out to our good friend and colleague, Peter Lawrence, who is the Chief Public Policy Officer here at Novogradac. And Peter has been doing yeoman's work recently with the reconciliation bill that was passed, I guess, a little over a month ago now, in which we had some notable wins in the LIHTC industry as well as the new markets industry. And certainly that is in large part due to Peter's great efforts. And I'm just glad that Peter can now get a little bit more sleep these days now that the reconciliation bill is passed.
Yes, and I'll echo that. Peter played a valuable role over many, many, many years that culminated in the permanency of the new market tax credit and the expansion of the local tax credit, also the permanency of opportunity zones. And, as bad as many of the renewable energy tax credit provisions are, without Peter's efforts, I have no doubt they would have been worse. So Nicolo, thank you for being on the podcast today.
Thanks for having me, Mike.
And to our audience, I'm Michael Novogradac. Thanks for listening, or thanks for watching.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.